Hey guys, welcome to the next lesson. In this video, we're going to be talking about indicators and how we use them. So what are indicators and why do we use indicators? Well, they exist to help with entries and exits, essentially. So the overall trend and market structure we understand from our patterns and impulse correction, continuation, all those principles. Um, so the problem most traders come to is knowing exactly when to enter the market. And while there's no magical indicator that exists for knowing exactly when to get in and out of the market, there are some indicators that can get you very close that I will show you here, obviously, in this lesson. So the two main types of indicators are leading and lagging indicators, and they serve two different purposes. So a leading indicator is useful for ranging markets when the market is going sideways, while a lagging indicator is useful for a trending market. So there are literally thousands of indicators available. However, there's a lot of noise out there. So we are going to focus on a few lagging and a few leading indicators and explain how we use them. So indicators are very useful, and let me just get this out of the way up front. They're so useful, but without a base knowledge of the market structure, the zones, impulse correction, continuation, breakouts and fakeouts, everything else, they won't help you. So there isn't an indicator that will trade for you, but they're very useful when you know how to use them. So let's start with leading indicators. And leading indicators are supposed to be predictive, meaning they'll help you predict when a trend is about to change. So the two main leading indicators that we use are RSI and Bollinger Bands. So RSI is called also known as the Relative Strength Index. And what that does is it tells you the overall strength of a trend. Okay, so to find the RSI, just type in RSI into the indicator search box, which you can access right here, and bring up the Relative Strength Index. And that will bring up this on the bottom of your chart. And here's how we use this. So like I said earlier, this is really nice in range-bound markets. So when the market is moving sideways, this is one thing we use to trade a sideways market. So as you can see here, in this sideways market, the RSI was able to tell us when to sell and also when to buy. And again, when to sell right here. So as you can see, the relative strength, once it breaks above this 70 mark, it's considered overbought. And once it breaks below this 30 mark right here, you can see the numbers over here. Once it breaks below this line, it means that it's undersold. Or, I'm sorry, it means that it's oversold. So when the RSI is overbought and it's at an area of support like this, it's a really good indication that price is getting ready to sell. Okay, so you can see that here we're overbought and we got a nice little sell here. You could have taken it here or ridden it all the way down to here. And again, right here, we saw a fake out, but price didn't continue that way. So when it closed back down inside of this ranging market and RSI was still overbought, that's a really good indicator that you can hop in for the sell right there. So that's how we use the RSI. When it's overbought, we look for a sell. And when it's oversold, we look for a buy. It's pretty easy. But sometimes it can fake you out. So you just have to be careful. And really, like I said, the best place to use it is in a ranging market. The next thing we use is a Bollinger Band. So just type in Bollinger, and it'll bring up your Bollinger Bands for you. So what we can do with a Bollinger Band is combine it with the RSI, and what that will do is give us two areas of confirmation. It'll give us two things that we can look for in order to confirm a buy or a sell. So we'll use the same example that we just had. We had overbought conditions here, and it was touching the top line of the Bollinger Band. So that would indicate a sell. Again, it happens here, and it happens again right here. And like I said, it pops out of here, but that's just a fake out. Price ended up coming back within these areas and closing all the way down here. So a sell anywhere in this area would have been a good place to get in. So the Bollinger Band also can be used in trending markets as well. So in a trending market, the Bollinger Bands are going to, let's take this short little uptrend we had here. Okay, so your Bollinger Bands are actually going to pinch together when you're getting a correction. So when this correction was forming, the Bollinger Bands were also pinching together. And that lets you know that a breakout is going to happen fairly soon. Okay? So next, let's get to some lagging indicators. And the two lagging indicators that we use, let me get rid of all this stuff here. The two lagging indicators that we use are the moving averages and MACD. So with moving averages, these show price over a set period of time. So for example, if you have a moving average and you set it to 30, it will give you 30 bars of whatever time frame you're on worth of data. Okay, so let's say we're on the 15 right now. Get rid of these Bollinger Bands. Actually, I'll just bring this up here. Get rid of the MACD for now. I'll bring that back up later. So these are the moving averages that I use. And just to make, just to give you an example of what I was just mentioning, like to set the time period on it. So this one says 80 close. So that means that this line right here, the one that has the dots on it, this is tracking price over the past 80 bars. The past 80 15-minute bars. This is what the average price has been. And this is important because price tends to revert back to the averages during a correction. So when it moves into the area of these moving averages, we know that a correction is taking place or is about to take place. Or, I'm sorry, a continuation is about to take place. You're in the correction and a continuation is about to take place. So moving averages are nice because they provide a dynamic support and resistance, which that just means that it's a moving support and resistance line. And as you can see, it acts as really nice support right here and right here. You get two nice corrections right there. And then in this area, we started to chop around. We broke down below it. And then we had a fake out in this direction. So we break back down below the EMA and come back to test these areas, and we get another sell. We pop back up into this zone right here, back into the EMAs. Yes, it popped a little bit above the EMA, but if we examine the price action here, we can see that we had a rejection here and a rejection here. So price was failing to go higher. And finally, we had price action, a nice bearish engulfing candle here that indicates that this trend was changing or continuing, that this correction was over and it was going down. But let's say you felt uncomfortable because, price went above it and you didn't want to sell when maybe it was going to do an uptrend, because you never know what price is going to do. It could have easily just gone this direction. That correction could have gotten bigger, created a flag like that before breaking down. It could have retested this zone before breaking down, which is why this price action right here is critical. But let's say you didn't feel comfortable doing that. Well, no harm, no foul, because if you look right here, you get what I would consider to be a near perfect flag. Right there, going straight up to the correction. And that's clear as day. That correction right there, that's clear. Straight up to the EMAs. You can take a risk-taking entry up here, or you could wait for it to break out down here. Either way, you're solid. Either way, you secured. Let's see how many pips this is. About 70 pips. And if you got in here, about 113 pips. Not bad considering this was, let's see how long this took to play out. It was 1 day and 5 hours. Which is a really nice profit for 1 day. Okay, so there are 3 types of EMAs. There is an exponential moving average, which is the EMA. There's the smoothed moving average, which is the SMMA. And then there's a simple moving average, which is just an SMA. We use exponential moving averages and a smoothed moving average, the SMMA. And what this does, the EMA basically weights the data and it gives more importance to the most recent bars, whereas the simple moving average will just take the average of all the bars in that given time period. So with the 80 EMA, what's happening here is price is being averaged over 80 bars, but it's giving more weight to the bars that have previously occurred. Whereas a simple moving average, it'll just take the straight average of all of them without adding weight to any particular bar. What a smooth moving average does, it's very similar to that. But with the smooth moving average, it's designed to take out more of the noise. So a lot of the spikes. So it'll throw out highs and lows within a given period and give you a nice smooth line that's going to approximate the trend. So the way I have my EMAs set up is very unique. You won't find this EMA, especially this red one, the SMMA, the 23. This one is, you won't find it anywhere else because it's proprietary. I came up with this one. So the reason why I wanted to come up with this is because when you're identifying patterns, this EMA is going to let you know when a pattern is about to finish, when a correction is about to finish. So just a few examples here. And we've actually got one playing out right now as I'm doing the lesson. You can see it triple tapped this EMA and it's, obviously starting to break down right now. So since this lesson started, it's moved 20 pips already. Not bad. But back to the examples here. I mean, you can just see there's an impulse. Here's your correction. It's testing the SMMA, and there you have it. And over here, it tested the SMMA, but it never gave us any bullish price action. It broke down underneath, and then it broke up briefly for that fake out. But again, as you can see, it came down and then it corrected to it, and it came down and it corrected to it, came down, corrected to it. So really, when you trade like this, I mean, trading isn't extremely difficult. If you know what basic market structure is, you know how to find your zones, um, you know how to follow a trend and not trade against the trend. It's not extremely difficult. It's just being patient and studying the market structure and putting the time and effort in to learning these things. Because it's not so hard to say, wait till it gets to the red line and sell. Wait till it gets to the red line and sell. Wait till it gets to the red line and sell. So, what you have to do is just practice learning your patterns and practice looking at market structure. And one thing that I did, and this is how I went from being a good trader to being a great trader, I would take my bar replay, which are these dots right here, and then I would just watch how price would play out during during a reversal or during a trend. So you can, you click on this button here and it'll play the price for you. Okay, so right here we're in a zone. So we're not really looking for a sell necessarily right here because we are in a zone. And I'll mark that for you. This is a little bonus back testing within the lesson. Okay. So you got that zone. So we're seeing what's going on. Okay, we're testing the EMA. Okay. You say, well, we'll get to the red line and sell. Well, we didn't really slow down at all. We just broke through. So now we're waiting to see if we get bearish price action below it. So you can see we did get some bearish candles, but look, rejection, rejection, and these candles are very small. There's no real bullish momentum happening right here. Okay. Looks like the bulls are picking up. We've got our crossover right here, or we've got our retest right here. So if we wanted to, we could just get in. We could get in right here. Put our stop somewhere below here. See how it plays out. So yeah, it did. It came below it a little bit, but you're fine because you were protected by your stop loss. And that's a nice little 65 pip move, and you're only risking 26 pips for that one. So that's good. Okay? So you can just see how it plays out. And we'll do it again. And you can see this correction's happening, so you know that you know how the market moves. You know what moves: impulse, correction, continuation. So we're in the impulse. Now we're correcting. So let's see how the correction looks. Okay, made a little flag here. Okay, we're testing the SMMA right now. Boom, right there, that price action. That's what you're looking for. You can get in there if you'd like. Place the stop wherever you're comfortable placing it. I mean, you can put it down here if you want. That's a huge stop, but I mean, some people like to use bigger stops. That's fine. It's your personal preference. I would put it somewhere below the SMMA in a reasonable range. Take profit wherever you want your take profit to be. It depends on your strategy. This could be a move that you hold for months, or it could be a move that you hold up to here. It's completely up to you. Okay, so the correction, it comes back down to retest, but you can see it's holding pretty well. There we have it, the breakout. Okay, so that is the basis of how we use our MMAs. And this next part is extremely important. So let me show you how I set up my EMAs, because you're not going to know how to set this up. It's not just the 23 SMMA. So you have to go in order when you're setting up this EMA setup like this. So let me write that out for you. So number one, place the 80 EMA on your chart. Number two, place SMMA on chart. Okay, so when you place the SMMA on chart, you're going to set the length to 23. And the source to EMA instead of close. And what this will do is instead of smoothing out the last 23 bars of data, it's going to smooth out the average, the 80-day average of 23 bars of data. So what that's going to do for you is create an EMA where it really just follows the trend. And look, to be honest, I can't tell you exactly why it does it. I don't know why. I don't know the answer. But all I can tell you is that it follows the trend. And so when I came up with this, all I was trying to do was get a line on my chart that would really accurately predict corrections. And that's what we found with the 23 EMA. So let me show you what that looks like. So one, place 80 EMA on chart. So we'll go to our indicators and we'll type in moving average. And we'll go to moving average exponential. Okay? And that moving average exponential is going to put a random EMA on your chart. What you want to do is change that length to 80. And then put it on your chart. And actually, let me do this on a blank chart so that I can show you guys from scratch. Okay. So we'll go moving average. Moving average exponential. We'll get that on there. We'll switch that to 80. So now we've got our 80 EMA on the screen. Step one is done. Now step two, place SMMA on your chart. And you have to put 80 first, otherwise you won't have anything to bind your SMMA to. So to find your SMMA, type in the word smoothed. And it will give you your SMMA. Your default length will be set to 7. Again, change that to 23. Set your source to EMA. Change the color to whatever you like. I use red. And voila, there you have it. You've got the SMA on there. Okay, so that's how we use our moving averages. The next thing we use, so remember, lagging indicators are used to predict trends. So we have an EMA, as you can see, that does this very well. So now the next piece to the puzzle is just another confirmation piece for you, and that's the MACD. MACD stands for Moving Average, Convergence, and Divergence. Basically, what it does is it shows the momentum in the market. So here's the one I use. I use the MACD 4C option, which you can find right here. This is the one I use. And you can find it by going to your indicators and type in MACD space 4C. And you want one with the signal line on it. So you can use this one or this one. Either one's going to be fine. They're the exact same. Okay. So the signal line, let me zoom in on my MACD here. So the signal line is this blue line that's going through here. Okay. And then the green, the green and red, I'll call them mountains and valleys. The green and red mountains and valleys, that is called your histogram. And this shows the momentum in the market at that time. So again, using just, let's see here, get out of that mode. So using the same chart and all the same examples that we just used, let me show you how this works. So we've got our EMA. We have our knowledge of the market. We know that this is an impulse. Okay. That's an impulse. And this is a correction. Right? So how do we know when a correction is done? How do we know that this correction is done forming here and it's not going to correct, like I mentioned earlier? How do we know it's not going to correct all the way up to here? Well, first of all, we've got our EMAs, and it's respecting that pretty well. It broke above, but it wicked back down. It was started to reject this high right here that you had previously. So, another thing that we can do is, if you notice, every time a correction ends, so right here, right here, right here in this area, it's happening right now. Every time a correction ends, look at your MACD. You get a small cross like that. Again, a small crossover like that. And again, another small crossover indicating correction. Okay? And in the opposite way, we broke through the moving averages with our impulse. Again, we're starting to correct. We came straight to the SMMA, and we got our cross right here. That's your correction. You can see that in multiple ways. You know that's your correction because the MACD 4C is showing you that. It's no longer impulsing upwards, okay? If this, obviously it's not an impulse. We know it's a correction. It has to be a correction because the market only moves in impulse, correction, and continuation. So this has to be corrective. And this is confirming it. And then you retest the SMMA right here. And then you cross back over into the green. And you can go. That's your confirmation right there. That's how indicators can help you once you know the other parts of trading, once you know the market structure. You have to know how these things work before the indicators are even going to be useful for you. So once you have the concept of impulse, correction, and continuation down, we can use these indicators to help us time our entries. Because like I said, you don't know if that correction is going to end here or over here. Because this correction could have been a very short correction and the whole trend could have looked very different. So basically, instead of getting all of this extra kind of corrective price action, it could have just gone straight to that. I mean, there's no reason why it couldn't have. But if we would have taken this trade right here, see, it's taking this, these indicators are keeping us out of getting into a trade early. And while an entry here is still good, don't get me wrong, because let's see what we would have ended up getting on a buy here. we would have gotten 109 pips on this buy. However, we would have had to have waited an extra 14 hours. So that would have been 14 hours exposed to the market. And the reason why that's important is because any news event could have happened in that time period. Anything could have happened. So by getting in when this happens and you have this condition, you've got the SMMA being retested, and you've got this happening on the MACD. We'll call this the zero cross. You've got a zero cross and a test of the SMMA. This is telling you that price is ready to go. So instead of waiting for 14 hours, you wait for 3 hours and price gives you 111 pips. Okay? Another thing. When you get the big impulsive bars, or I'm sorry, the big impulsive, signals on the MACD like this. So price went up quickly, so the momentum also went up quickly. One thing I want to share with you is that whenever an impulse is done, the histogram will cross below the blue signal line. So whenever an impulse is finished, the histogram will cross the blue signal line. So let me show you a couple examples. You've got your impulse right here, okay? Well, how do you know that it's actually correcting right here? How do you know that this impulse isn't just going to keep going? Well, there's the main way that I measure this is that you can see we get to the top here. One, we have this rejection candle right here. Two, shortly after that, we have the histogram cross under the blue line. So that lets me know that we're having a correction. That lets me know that I need to wait until we have this area right here, until we have this scenario with the SMMA and the zero cross. And again, same right here. So we have our impulse down and the correction starts. You can see this right here. When the histogram crosses the signal line, that's when this correction started. The correction was over after we got the zero cross and price and the histogram crossed back under. That's when we got our next move. Okay, so we got this tiny impulse here, and then we got our correction, as you can see, because the histogram crossed under the signal line. Our next signal to enter was right here because of this and because of this. Boom, we got that. We got another mini correction right here. And price continued from that. And now, current conditions. Price made a correction. Gave us a zero cross. And now we're coming back down underneath it. Okay? The other way we use MACD is to look for when a trend is coming to an end. So the way we are able to do that, let me delete everything here, is something called MACD divergence. So let's pretend that we are back here. This is a good example. Okay, MACD divergence. This is when price and MACD are trending in the opposite direction. Price and MACD are trending in opposite directions. So what we've got here, for instance, is an uptrend. Okay, this is an upward channel. And again, we're using MACD to signify or indicate when a reversal is likely to happen. So we've got an uptrend here, but as you can see with the MACD, it's in a downtrend. What does this mean? It means that price is pushing up, but momentum is slowing down in that direction. It means that the bulls are losing steam. This is also known as an ascending channel, which you know as a reversal pattern. So your ascending channel is also giving you this divergence here. That's two indicators that we're looking for a reversal of price. Now, there's two ways to trade this. You can try to get in at the tops here. When you start to see the divergence, you can try to get in on the tops for the reversal. Or you wait for price to break down, correct, and again, break down and correct. Your EMA will also come down like this. You'll correct into the EMA. You'll break down, get a small cross. You can predict price to do something like this, and you can wait for that. And that, honestly, is the safer trade, and that, honestly, is how I would trade it. Because you always run the risk of, price, you don't want to trade against the trend ever. So, yes, this is an uptrend. It's a weak uptrend, but it's still an uptrend. And you don't know when it's going to reverse. You have to wait for price action. So, if you would have seen this channel, you would have noticed divergence here. You could have gotten in here or here or here or here, but it pushed up, pushed up, pushed up, pushed up. When you could wait, boom, crossed under. I mean, that's a huge candle right there. Okay, so there you have it. Okay, so you had your impulse. And you had this cross right here, which means that the correction is underway. It would, we can use the EMA to predict what kind of correction it might make. And it made a pretty small correction. You probably could have gotten in when it broke this bottom, but we'll see what price does. Ends up going down. Correction's taking longer, but that's okay. Now let's see here. Okay, now we're getting the zero cross. Price is testing the EMAs. All right, we crossed under right here. So your position could have a short position there. Whatever take profit you want. It's just to give a small example. Correction getting slightly bigger. I didn't really analyze this to see where a stop loss would be. I'm just trying to show you how price moves. Okay, so the correction got a little bigger, which that happens, honestly. Okay, so you can see it again. So we had an impulse in the opposite direction. Now we're correcting. Okay, so you can set something up like that. Had the correction, zero cross. Let's see what price does. Okay, there you go. That's easy enough. So yeah, this trade we lost out on. But I mean, really, if you look at it, we didn't get any great price action here. I was just trying to make it happen. I thought it'd be cool. But for this one, and that's the other key too. I mean, you have to wait for the price action. And don't trade if you don't have time. Like that, I was just kind of rushing it. Just kind of clicking through really fast. So wait for this price action here. Boom. You're good to go. Okay. So that's pretty much it for us, guys. Actually, one more thing is the Fibonacci tool. So the Fibonacci tool is going to also help you measure corrections. So the key with Fibonacci is to know how to use it. And the best way to use it is to measure your corrections with it. So how we do that, let me find a great example for you guys. Okay. So in general, after an impulse, price will correct to a specific level on the Fibonacci. So the three levels that I focus on personally are the 382, the 0.5, and the 0.618. However, if you want to take a screenshot of my settings, I think that's all of them. Yes, if you want to take a screenshot of my settings and the numbers I use, go ahead and do that so you can have them for reference, and you can set your Fibonacci up the same way. So in general, price will, like I said, retrace to the 0.382, the 0.5, or the 0.618. So what we use the Fibonacci for is we just look for price to start reacting in these areas. We look for price action in these areas. So like you can see on the 0.5, and this is on the daily chart. So at the 50% mark, or the 0.5, we got a rejection here. So that is a pretty good indicator. Oops. If we go down, if we go down in price, or I'm sorry, go down a time frame, you can see that we started to get this rejection here off of the 0.5. And that's what we're looking for. We're looking for price to reject off of specific Fibonacci levels. So let's switch to another chart. And we can show you Fibonacci again. So Fibonacci happens over and over and over again. So right here, you've got your 0.618, and then you got your buy. Okay. And that's the basis of your Fibonacci. So after you get an impulse, just give you a manual drawing here. So after you get an impulse, okay, and you're waiting for the correction so that you can enter on the continuation, you pull your Fibonacci from the swing low to the swing high, or vice versa, whichever way the market is going. You go from swing low to swing high, and then we wait to see if price gives us a reaction here, or if it gives us a reaction here, or if it gives us a reaction here, or if it does a deep retracement and gives us something here, here, or if it retraces all the way back down to the 0 line. Okay? So in general, and this is just something to supplement your pattern kind of knowledge, your flat corrections typically retrace to the 0.382. Your expanding triangles are typically going to retrace to the 0.618 or to the 0.5. Okay? Your typical like flag corrections are going to go anywhere from the 0.5 all the way back down to 100%, all the way back down to here for a flag. Okay, so that can just help you predict what kind of correction we're going to get and when to enter. So when you combine that with the MACD and combine it with the zero crossover, and combine it with the Bollinger Bands and everything else, it's easy to see how you can come up with and follow a really easy strategy to have a lot of confidence when you're entering and exiting the market. So that's it for indicators. Um, and like I said, I just want to reiterate one more time that indicators will not teach you how to trade, and it's no substitute for learning the markets and learning how to trade. So learn your impulses and corrections first. Learn how to spot those. And then you can use your indicators to help you with your entries and help you know when your corrections are going to end and when you can get on for continuation trades. All right. We'll see you in the next one.